Today, folks, the conversation around the stock market is getting a little delulu. Are we too bullish? Is this frothy? Is it time to take profit, baby? Is this finfluencer clown starts breaking down earnings to see what the hell is going on, knowing we have no idea what tomorrow brings? But if we look through the past, baby, cost averaging 2009, 15 damn years ago, you'd have said it was too frothy. And look where we're at today. This is why we cost average the highs, the lows. Who gives a crap? Nobody knows. But taking a look at my portfolio, I'm sitting here like many of you, realizing we're making more money off our portfolios than we are our jobs. And when things get too damn good, sometimes we have a hard time trusting or believing it. And obviously with the PE so damn high, let's talk about it, because I can't get over that in the last 5 days, the S&P's up 1.5%. Schwab, SCHD's up 2.6%. VDY up 1.5%. You look at the last month, and again, these aren't huge gains. I know a lot of people are too used to their baggers and Palantirs and their Tesla volatility plays and all that stuff. I'm a very simple guy here. So on a monthly basis, when I'm seeing my ETFs jump a few percentage points, you know, when you have a few $100,000, I mean, you're talking about like, what is that, 4-figure movements? I mean, it's kind of staggering, right? When I log in here and I'm like, damn, how'd we get to 340? It feels like we were just at 300 yesterday. Weren't we? Like, where'd all this money come from? It's kind of wild. And this is what compound return truly looks like in a very stable, boring fashion. But let's talk about where the market kind of goes from here, because I'm sure many of you have been scrolling through your stocks, seeing a lot of variance in the stocks that are performing and not performing. Today, the S&P dropped. SCHD's holding up a bit, but then you got your utilities, your real estate just popping off. Like, it's so roller coaster right across the board. Even Nvidia's down 5% after that incredible run that it just went on. So let's just see if making more money than God can be justified at this high price to earnings multiple today, as we literally take it to the bank with earnings from Goldman Sachs, Bank of America. We're going to talk about a sleeping giant that I think has huge upside, Johnson & Johnson, for you dividend lovers. And we're just seeing the spectrum, the pre-warm-up game for the mega cap tech company earnings next week. So if you are on a path to financial independence, if you love making more money than God, go hit that subscribe button. Join me on that journey and smack that like while you're down there, baby, because yes, I'm so excited because it's so many, important things are happening in the next couple weeks. And firstly, I want to talk about the banks because they ebb and flow, but like Pokemon cards, I always suggest collecting them all because we don't know what ones will perform better than others in certain time periods. I'm more fixated on the Canadian banks, but we'll talk about Goldman Sachs and Bank of America here, because Goldman Sachs has been on a tear. It's outpacing the broader markets, largely actually over the last 5 years. Year to date, it's up 34%, which is quite staggering. And that has a lot to do with this earnings growth from their investment banking side, which is growing at a 24% clip. But what makes Goldman Sachs so damn impressive is the fact that if you take a look at their total revenues growing at 13%, that is comparable to the likes of Google. I mean, Google's in their last quarterly report was only growing 13%, and double-digit growth is nothing to like blink an eye at. Of course, it's not comparable to your Nvidias of the world, but for a bank, that's friggin' amazing, right? So we start getting a little bit more justification for higher values here. If we take a look at Bank of America, obviously the Warren Buffett favorite, it's still kind of coming out of the 2008 financial crisis. This is one of those ebb and flow banks. It's still outpacing the broader markets. They're kind of in line up 25%. Keep in mind, you are stacking in some nice dividends and dividend growth here, but this one's super boring to me. I don't know why Warren Buffett loves it so much, because it just doesn't have any growth. It just kind of has been playing around in this $10 billion range, right? Like, if you go back, to 2023, similar quarter period, we're only from 10.4 billion to 10.4 billion is nothing. There's been no growth. Take a look at net income. Net income is flat. It hasn't really gone anywhere either. So Bank of America doesn't get me all that excited. But again, if you're just an investor, you're buying the broader banks, there's nothing wrong with these earnings by any mention, but we want growth. I mean, that you can't justify a 30 PE on no growth. I'm just saying, like, you really need some explosive capability. So how do we get that explosive capability when we don't have growth? Well, Johnson & Johnson, I think, has proven some stuff that hasn't justified into the stock yet, and it has to do with some one-time write-offs, because J&J is only up 29%. It's been lagging the last 5 years, which is quite depressing if you're a total return-oriented investor. But as income-oriented investors, J&J is paying a 3% yield right now, which is very healthy for this mega giant, this $400 billion medical company, very diverse too, from obviously drugs to medical devices to things like Tylenol and Band-Aids. And this company's got decent growth for the giant that it is. 5% growth for Johnson & Johnson year over year from the revenue side is not bad at all. I mean, compared to the volatility of Pfizer and some of these other, drug pharmaceutical focused companies where when those pharma drugs don't start doing well, the stocks tank, Johnson & Johnson's got better diversity, makes it one of the most resilient companies in the world. And net earnings were down 37%. So people are probably like, oh my God, that's so bad. Why is the stock up when earnings are dropping so much, right? Like the stock really bumped up today, giving up 2 percentage points, but it has a lot to do with one-time write-offs. If you read into this, they had a one-time charge and they acquired IPR&D. They are doing acquisitions as well, which is all great for us shareholders. And I want to point out that the most incredible thing about what Johnson & Johnson is doing today is share buybacks. This is the perfect formula storm for what I consider to be undervalued stocks. When you get reasonable growth, you're getting a company that's paying a dividend, increasing a dividend, and then you get a company that's also buying back shares and still has enough cash to acquire other businesses. This is the true sign of what you really want to own if you're buying individual stocks, because I don't know, in the last 10, 15 years of their history, they have never acquired shares like they are right now. So at some point in the future here, that's going to hit the bottom line of earnings, and they're not going to be doing these one-time, write-offs or acquisitions. And I think people aren't maybe not appreciating as much as they could be at a 10 PE right now. So I think there's some real potential here, and this could really offer better than average returns from the historic, 5-year return that we've seen. It's just my humble opinion. I could be wrong. I'm just a Finfluencer clown looking at the data that I have just as much as anybody else out there. But what I'm really looking forward to and where the earnings have to be justified today are in the mega cap companies, primarily the chip companies. They're the ones that have been really driving up value, and TSM, ASML, they're going to be posting, and they are not going to put up shy numbers. And I can tell you that because TSM they post their monthly revenue numbers, right? So we get net revenue every single month. And look at the last quarter, 40%, 33%, 39% growth year over year, slowly continuing to trickle to the upside, which really falls in line with the CEO of NVIDIA saying that we have more demand than ever, for these new chips. And it's likely that demand hasn't started to slow down just yet, which is a good sign of why NVIDIA, ran up so much just over the last month. So we could see an all-time high in NVIDIA potentially after earnings. And that could, again, start to solidify and justify a 30 times multiple on the S&P. I'm not 100% certain, but what I am more confident of than ever before is a soft landing after hearing all the other Finfluencer clowns constantly contemplate this next recessionary event. Meanwhile, it really truly looks like we are still on the path of a soft landing. There's no guarantee, obviously, but when we continue to see really good earnings on the back of a really strong bullish market, could we get a correction? Sure. Without a black swan event, though, like I said, that's not going to stop me from buying. It's not going to stop me from cost averaging here because, when times get good, you kind of got to look back when times were good, and they've been good for a while. That doesn't mean they're going to be good in the future. Past performance doesn't equal future return. But the only thing that I can assure myself of is I go make my money. I invest it. I'm not drinking $5 damn Starbucks, which in the next 30 years will equate to hundreds of dollars in value. Every day not drinking Starbucks will equate to hundreds of thousands of dollars in value. If you don't believe me, go use a compound calculator. This is why I've been able over the last decade to accumulate several $100,000. Is just this simple formula. I just keep buying, baby. What are you buying? How are you managing the markets? And are you making more money than God? I'd love to hear about it in that comment section below.